So mistake number one is letting winning or profitable trades turn into red trades, especially ones that I get at least a minimum 2-to-1 risk to reward, where I'm in profit 2-to-1, but I let that even go red or break even on me. So the first trade I took long on the S&P 500 about 25 minutes after the market opened, and I just want to discuss context backing all of these setups first. Let's go over the pre-market plan. I post these every single day in the Discord of the setups I'm watching, levels I'm looking out for, and potential trading scenarios. So on May 14th, the main thing that I was watching for was the market was fairly balanced. Now, I love trading balanced markets because I am personally more a reversal trader than a breakout or continuation type of trader. So what I like to see when the market is balanced is if the market breaks outside of the move, does it get accepted or does it get rejected? Now, I wanted to gauge this around 52.30, that if the market could hold 52.30 to 52.20, I am interested in taking the market long. 52.30 to 52.20 is this green box over here where you can see the market was very balanced. We broke under this little support low into a level of demand off of news. It got bought up, and then the market rallied up off of that news, off of this level. And my bias for this day, or my structure of where I was looking to play, was more towards the long side because of the strong recovery and because of how strong the market was while it opened up. And my plan was to see if this level on the S&P 500, 52.49 to 52.46, could hold. That if it could hold and buyers appear, I am interested in taking the market long, targeting 52.65. The market pulls back into this level, and I find valid confirmation to take the market long as it's dipping down, because what you could see here is a little bit of a support level. That the support level breaks, holds above 52.46. I'm going to mark that as a level, and we begin to start slowing up and moving up, and you could see the buying volume also increasing down here. So I'm like, okay, comfortable, small risk. Let me take it long, targeting that supply zone above. Right, this trade begins to work out. We rally up past the high of the day, and then we start dipping down, and I exit this trade for a $1,300 loss. Now, my rule of thumb moving forward, and this is where tweaking your setups and reviewing the trades will be so beneficial for everybody, including myself, is on that setup, I was up 2R, and I had to sell it for a loss. The next trade, as soon as I exit that trade, 3 minutes later, I re-entered the same exact setup as this thing is bouncing off of VWAP. It's holding 52.46, and I try it long at 52.48 with a 3-point stop loss and a 17-point target. Now, the issue with this was I was first targeting high of day. My original target was 52.55. So if I input this, which was high of day, I was maintaining a 2.3 R multiple. However, I was going for a little further of a target, and now my planned R multiple was about 5.67. Now, in this setup, when it bounces off of VWAP, right, because we take it long at 48s, 3-point stop loss, 10.21, it's holding VWAP, find valid confirmation to take it long, and this trade was a beautiful thing that worked out in my favor. And if I were to pull up my running P&L here, I was up at one point $5,300 5 minutes after I entered this setup. So there was zero drawdown on the setup. It immediately worked out. The market rallied up in my favor 5 minutes after entering, and then the buyers ran out of steam, right? Everything looks great. We broke above the high of day, which was my first target. In hindsight, I should have scaled out. And then it dips down, and I get out of this trade for a $1,000 winner. I let a $5,000 profit that I never had go into a $1,000 winner because I got a little greedy and didn't sell at my first target. Now, I recognize this, and now this is when things begin to get interesting moving forward. I'm very upset. I'm feeling very frustrated seeing this thing dip. I thought it was a great setup. It was a great setup. It rallied about 12 points in my favor, and then it breaks under VWAP. I see it rejecting VWAP, and I take a stab at this thing short because my risk was very, very minimal. 3-point stop loss again for a 16-point reward. Once this thing was rejecting VWAP, got a little greedy with this, eventually went out of my favor, and it was a very forced trade, and it was a $4,000 loss that should have been completely avoided. Now at this point, I'm very emotional. A forced trade, a 12-point profit going slightly green on me. an earlier setup that just simply did not work out. I see the market in the middle of this range and I see this consolidation and I take a stab at this thing long, which resulted in a $2,000 loss, basically trading in no man's land. So a very helpful tip is if you see the market very balanced like this, in my opinion, completely avoid balanced conditions, trading in the middle of the range. In balance, the best edge or the best odds or probability will come at the highs or the lows, not in the middle of this range. For me, where I've entered here, we're in the middle of this trading range on a balanced session, and this cost me about $2,000. Still a 4-to-1 R multiple, but it did not work out in my favor. Next setup, $4,000 losing trade. Forcing setups left and right, getting greedy, not exiting at my stop loss, and I'm trading in the middle of no man's land where I had no business doing so, and this resulted in a $10,000 loss on the 14th of May. Zooming out, I had all the best analysis because we got the rally that I wanted, end of day, but by the time it happened, I was frustrated that I shut down my computer because I was trading in the middle of this balance. So do not trade in no man's land in the middle of balance. It's best to trade at the lowers or the upper extremes of a balanced day where you're looking to fade those edges. So now May 15th comes. Solid trade, but the first one was a minus $2,800 loss. If I did not have this loss on Wednesday, I took 3 trades. If I didn't have this loss, the 2 trades that I took would have completely outweighed the previous day, which was the $10,000 losing session. On this setup, it was a 5.8 R multiple, excellent risk to reward. What I saw here was the market rallied up off of CPI data. Now, for me personally, I like fading the moves of CPI data if buyers or if sellers could become trapped. So the market gets that strong rally up on CPI and we're inside of a very, very key supply zone. I see this and my thesis was you're going to have a lot of buyers FOMOing into the market, meaning they are chasing this breakout. They see the market rally up in the first couple of minutes. They chase it. And I saw that on the volume patterns, right? I saw all these trap buyers buying the market. I saw it stall out. And 8 minutes into the market being open, I tried a 3-point stop loss for a 15-point reward. 5-to-1 plus risk to reward ratio. Excellent risk. And that's something that I always do. I always maintain the risk. The market sold off and then stopped me out for a 2-point loss. Now, this is where it's vital for a short-term trader, and I'm very good at this, and it's a skill that a lot of traders need to implement, that sometimes if you stop out of a trade for a loss, maybe a minute after, 5 minutes after you exit for a loss, look for a re-entry. Don't throw the towel in on your analysis because you took a loss. If you took a loss, maybe you just mistimed the market. A few seconds after I stopped out of that trade for a loss, I re-entered with the same plan, same thesis, because I saw a valid confirmation to take the market short around 9:45. That's when the market looked like this right here, rejecting the level, sells off, right? Keep in mind, my target was at 52.85. The reason why I came up with 52.85 was because if you were to pull back the tape from the CPI rally, you would see massive buying occurring here, causing the market to continue up. So my target was 52.85, and I'm short here around 9:46 at 52.99. 3-point stop loss, 15-point target to the downside. This setup resulted in a $1,200 win. The issue with this, and this is very similar to the setup from yesterday, was at one point I was up close to $14,000 on this setup. 4 minutes after entering, 5 minutes, I was up $14,000 in 5 minutes off of 3 points worth of risk. It was a 7-to-1 risk to reward ratio. So similar to yesterday, I see the market sell off. We are 1 point away from my target at 52.85. I'm up 7-to-1 risk to reward ratio at this moment. It reverses on me and I cover this trade essentially at break even, but for a $1,200 win. Now, a lot of people are probably going to say, Carmine, you should maybe trail your stop. And that's absolutely correct. I technically did trail my stop because I won't let a trade that I'm up 12 points ever go red on me. But you wouldn't be saying, Carmine, you should trail your stop is if the market moved up here and then eventually dumped coming into my target. Because what if I got all out here trailing my stop And then 5 minutes after, the market dumps and I sold for a $3,000 profit. But after it dumps, now I'm up $18,000 or $20,000. So this was a great setup, great confirmation, right side of the market, just poor execution because the market failed to hit my target, and I let this trade go for $1,000 profit on me. Now the next trade was the big winner for me, and this is why when you do win, you have to make sure you're implementing proper risk management, that the winners will take care of the losers. I could have took this one setup, and if I didn't take that earlier loss, this would have put me about break even from the massacre the day prior on Tuesday the 14th. This was a setup that I sized up for because of how small my risk was. My risk was 1.75 points. I was in at the 13.75s, risking under the 53.12s. 1.75 point stop loss for a 5 to 9 point rally up. Excellent risk to reward, but I sized up because of how small and how low my risk was in relation to my normal risk. If my normal risk is about 3 or 4 points, then going in with 15, 20 contracts is normal. But because my risk was only 1.75 points, going with 30 contracts made a little more sense to me because I was going for a smaller move with tighter risk. The market dipped down, and I'm going to pull this up here. It was a very slow mover on Wednesday, and I was itching to take a short. I was itching to reverse this move, and I'm very confident a lot of you watching this probably did take a lot of losing trades on the 15th by shorting this move, and I've learned my lesson doing this. My worst trading days come from when the market's trending up or down very strong and I tried to fade it. Instead, I went against the opposite and I took the market long at an all-time high break, which is something I'm so against, but like I said, the risk was so small. So removing all my levels here, what we're going to see is the market consolidated at the high of day. So I saw the market consolidate. It dipped down here, and there was massive selling pressure at 53.15. Similar to the setups that I just talked about before, I saw a ton of selling effort here between 11:30 Eastern to about 12 o'clock Eastern at 53.14, 53.15. So my thesis was on this dip down with heavy volume, coincided with a buyer buying the dip. That if this buyer put pressure on the sellers here, I'm going to mark this as a red one. If he put pressure on these sellers at the 15s, it would cause a further upside rally up. It's all about putting yourself in the shoes or the position of other traders. If I am a buyer here and I see sellers, I want to do everything to put those sellers on the water because that's just going to further fuel a rally up higher. So I saw the market rally up. I was in this trade for way too long, and I got all out of this trade at the 53.22s. It was about a 9-point target on my last scale for a 1.75 risk. Excellent risk to reward, and this one trade just completely put me back into the game, and that's why risk management is so key. So moving forward, what I'm going to do is I'm going to be a little more conservative with my targets, and also I'm going to start maybe looking to scale out some when I'm up 2 or 3R because I've had so many setups go up so much in profit that I either turned red or small break even or small profit. So a little tweaking goes a long way, and I'm very confident. We get in our own heads. I'm sitting here. It's frustrating, not being able to execute to my highest potential just because of simple little mistakes or tweaks that I know that could be fixed. So I'm not worried about it. It's important to forget about the past. What happened yesterday, what happened today is over with. The new day is a new scoreboard. We start 0-0, and our job is to use the lessons from the past to better prepare ourselves for the present moment. And if we put ourselves in the position of the present moment, that we don't fret on the mistakes in the past and we don't worry about the future, we're just going to be so better aligned with market analysis, and we're not going to let our emotions do the trading for us. Now on Thursday, May 16th, I had a $6,200 profit on the S&P 500, and this trade was very straightforward. So in the first 30 minutes, we were very flat, we were very, very balanced, and similar to what I said yesterday, where the market tends to break these balanced states and trap participants. Here we could see the market aggressively sell off from this 30 minutes worth of balance with very large aggressive volume pressure. Then it automatically rebounds up, and this is when it sparks my interest to take the market long because the risk was very, very small. As the market aggressively sold off, here you can see all the aggressive selling, and this is what I mean by trapping participants, and this is why I favor reading volume over a normal candlestick chart. On this aggressive drop with all these large red bubbles, it indicates aggressive sellers coming into the market, but somebody has to be buying from these sellers. You could see a very large red line and an orange and a yellow line indicating passive buyers are buying from these aggressive sellers. As the market was selling off, this corresponded by the drop, getting immediately bought back up, and around 10:11 Eastern time, I got long at 53.34 because this offered the highest probability with the smallest risk. Going back to the setups yesterday, my risk in this trade was 1.25 points, and I was only targeting a 6 to 10 point reward. So it was about a 6-7 to 1 risk to reward ratio. When I see the market this flat, it would not make sense to go target 20-30 points to the upside. The confirmation for this setup was that strong aggressive dip down, and if you were to zoom in around 10:10 Eastern time, you could see a larger buyer by this orange and red line working the market, meaning a passive buyer was present at 10:10, 10:11, where the market would come down into him, he would rebid, get filled, indicating that there could be a very large passive buyer in the market due to this structure. And with this information alone, I was comfortable getting long at the 34s, placing my stop loss under the 34s for very, very minimal risk. And eventually this thing rallied up and I got all out at the 41s because, again, I am not shooting for the stars with the current market conditions. So it's just adjusting and tweaking to fit the current market conditions. If you learned anything from this video, drop a like. If you have any questions, comment them. And if you're new to my channel, I recommend clicking that subscribe button. Peace out.